Well, good afternoon and welcome to the Market Carver. Hope you're having an outstanding week. Hey, I'm doing this on Wednesday afternoon after the market closed, so if you got to pay attention to the craziness of the market yesterday, or on Wednesday, we had revised economic numbers that came out in the morning. Then we got to hear Bernanke say that the economy had moderately improved. Very interesting verbiage. At the end of the day, right at the end, the market sold off pretty much flat for the end of the day. Adam will tell you, in his opinion, that the story of the day will wind up being the pressure that was placed in some of the areas. In this case, a goose and as he referred to it, in the tip spread. It'll be interesting to watch how it happens. The June accounted for one of the largest outflows of fixed income money in a long time, and that tends to be the theme of some of the things we're seeing across this market in different places. But moving along, let's first move to the Facebook. We had a few of you who asked us when Facebook first came out if we should get involved in the IPO. A couple of you called and said, hey, thanks for telling us no. And the honest answer is we really didn't know. Obviously, the technology's there. The Financial Enhancement Group has a Facebook page. We understand that part, but there's no way to be able to run that through a four-legged stool. Well, if you don't know the story, the stock immediately plummeted, and it got hit hard. This time, we actually have fundamental data. Facebook came out, had a reasonable report of earnings, and literally surged about 30% in one day. And that takes us to the next screen. This is a technical chart that you can look at. Remember, the chart has nothing to do with the fundamentals of a company or an economy or in a market or anything else. It just shows us money flow. And you can see in those two red lines, the top one being known as resistance, the bottom being known as support, that the stock price fell immediately after becoming public. A lot of controversy, you may remember. And then it began to get into this range channel, which was trending lower. So you were making lower highs, and then when it would reverse and go down, you'd made lower lows. It was not a good trend at all. Well, earlier this week, the stock's fundamental numbers came out. The stock surged 30% in one day and came up with what we would call a breakaway gap. Now, did that mean we went out and bought Facebook? No. But I'm trying to explain to you how the technicals work and how the discipline works. So moving to the next chart, this is a very busy chart, but it's the big boats. It's the institutional. And these numbers have to be reported. It's not like they want to hide them in a back room. But Bank of America, Merrill Lynch, is showing that their largest institutional sellers, their net institutional holders, were net sellers, and going all the way back to 2008 for the month, the largest amount of sales that have been done. And folks, we're talking about the equity markets here. This has been a very interesting year, but the retail investors continue to put money in, and professionals and institutions continue to say, wait a minute, there's something not quite right here. We have to watch the big boats for certain. The economic data, when you move to the next chart, was good. Undoubtedly, our economy is better than many of us thought. The market kind of projected that. We talked a few weeks ago about how John Herman, one of the analysts we follow, said, hey, this economy getting revised is very possible when you look back at 2012. I talked about it this week on the radio show. But you may have seen it, that we went back and revised all of our GDP numbers going all the way back to the 1929 era to more of an international standard. So we had better apples to apples to compare it to. But the revisions that were really important are the ones that came out of the last 5 years. It was reported that the GDP in 2012 was a mere 2.2%. Turns out it was about 2.8. Additionally, when you look at some of the changes they made, and I'm not sure I fully agree with some of the changes, but they didn't ask me. And if they match the international standard, then it's more of an apples-to-apples comparison. But we're going to be looking at that data for a long time. Remember, though, it's not the mass of the U.S. economy. It is the trajectory with which it improves or declines that will determine the fate of the market. Eventually, at some point, markets have to rest just to consolidate some of the amount of money that has been put inside of them. We know the largest flows of money always go in when a market's at its high. In this case, the big institutions, the big boats, are selling, and retail investors are putting in. And it's very reminiscent of a previous time in our life. And that doesn't mean that we're back to the tech wreck in the late 90s, early 2000s. It just means it's some of those things that we have to be careful of. Rules to live by. The market is driven, you've heard me say this many times, by both fear and greed. Fear wins over greed, and that's why markets can fall faster than they can rise, typically. Not always. We're starting to see more and more people come in with the conversation of, should I become more aggressive because the market is up? And the answer is, in hindsight, when none of the bad things that happened, that could have happened, of course we all would have liked to have had a whole lot more equity exposure that was going on. But the important thing to remember is you've got to manage for the things that could have happened, not for the things that did happen. It's easy to go back and look at the results afterwards, and that's part of that concern that we have of some of the attitude of some of the retail investors, things that we're hearing out of TD Ameritrade, and things that obviously came out of the Merrill Lynch report this week. Hey, don't forget the 529 program. If you have kids that are in school, going to college, or going to go to college, you can put up to $5,000 per year into a program for them. Forget the benefit of the growth being tax-free for education. The big benefit is the state of Indiana will give you a $1,000 state tax credit just for participating. So if you put in $5,000, you get a $1,000 coupon off of your state taxes next year. It's a really good deal for people who have kids that are there. There's some stipulations, so pay attention to them, but it really makes a lot of sense. It's clearly something that we use at the Clark household. If you're out and about Saturday morning, don't forget to catch the radio show 9 to 10 on WQME. Sunday mornings 10 to 11 on Shine 99, and of course you can find the newspaper column as well as old radio programs on the station or on our website at yourlifeafterwork.com. Folks, we appreciate you joining us. If there's anything we can do to be of service, please don't hesitate to let us know or call. We are more than happy to talk about what's going on. Having lots of conversations, probably will continue to for some time. So give us a buzz. Have a great day. God bless. We'll see you again next week.